Are we finally seeing a slowdown in ground up development? And if we are, is it happening fast enough so that 3-year rate slump we've seen in the industry might start to see the tide turn? Welcome to this week's edition of Storage Unlocked. I'm your host, Thaddeus Campbell, Director of Business Development and Strategic Branding at S3 Partners. The show, of course, brought to you, as always, by our friends at PB Brown General Contractors. Well, today, I'm going to turn the clock back 20 years to 2006. This was something that was incited by a conversation with Zach Dickens a couple of weeks ago on my other podcast, talking about the Storage USA acquisition, utterly game-changing for the industry, Extra Space, a little over 100 stores at the time, by Storage USA that had over 400 stores. Extra Space quadruples in size at the time, but still less than 700 total facilities at that time. Fast forward to 2026, of course, they're well over 2,000 owned stores. Public Storage going to be well over 4,000 owned stores after the NSA merger goes through, or acquisition, I should say, goes through. I wanted to break down the data. What has happened in those 20 years, and what does it foretell for what might be coming forward? Now, I'm not Nostradamus. I'm not going to tell you what this data means going forward, but I do want to lay it out for you so that you can see what's going on in the industry, where we are today versus 20 years ago, so you can make decisions on where you think this industry might be headed. The challenge with this, of course, in this journey is to take the available data and compile it correctly. I'm going to start with a chart that shows us the number of square feet of self-storage that exists. Of course, the SSA is the source for this. And I wanted to lay this graph. You'll notice it doesn't say 2006 here. It says 2007 because the 2006 data wasn't available without the paywall. I do not belong to the SSA Almanac. I probably should, but I didn't have access to it. So I had to get what was publicly available. You'll notice a couple things here, right? The square foot per capita between 2007 and 2016 shows an actual decline. Well, of course, that was the era of the GFC, right? So you had almost no capital going out, and so very little ground up construction happening in that decade. Of course, the SSA's numbers show a decline in total square feet, which is a little unusual. So again, it's data, and we've got to dig in and make sure we understand every aspect of it. Makes sense that the square foot per capita would have declined given that the population continued to increase. We'll show that graph later in the show. But then you fast forward to 2018, the SSA changed the way they compile data, and notice a stark drop in both square foot per capita and the total square feet of self-storage that existed in the United States. What jumps out to me on this graph, and what I'm going to come back to a little bit later as well, is the difference between 2018 and 2025. 1.7 billion square feet to 2.7 billion square feet. Now, of course, the SSA accounts for all of the self-storage across the country. We're going to show a little bit of data later that only targets the top metros. I want to be very clear on that because Yardi's tracking of development is only the primary market, so it doesn't show the full picture there. But just have in your head right now, 1 billion square feet of self-storage that the SSA says came online between 2018 and 2007. 2025, So in less than 8 years, 1 billion square feet when there was only 1.8 billion existing in 2018. So a staggering amount of new deliveries that have happened in that time, right? So I want to go back and I want to talk about where we were at in 2006. Extra Space buys Storage USA. As I said, they continue to grow strongly over that time. And in my conversation with Zach Dickens, and the reason I'm bringing this up is it kind of leads into why we've gotten into this crazy development phase that we're seeing in self-storage. I'm going to paint a big picture of why this has started to happen. And of course, the GFC happens in 2008. Interestingly, for Extra Space, they had done a great job of merging the Storage USA products, the assets, into their portfolio, specifically asked Zach Dickens whether or not they were still having some challenges as the GFC started of getting that portfolio immersed. We know from their acquisition of Life Storage, Public Storage is talking about it in the planned acquisition of NSA, that it's not as simple as just changing a sign on the door and adding those properties to your portfolio. There is a process that goes on operationally behind the scenes to get the software, the technology, the people all on board with that. So ask Zach Dickens specifically about that with the Storage USA merger. He said they were by 2008, when the GFC really started, they had been able to seamlessly transition those stores into the extra space model, use the extra space systems to make sure that that was going strong. So I want to talk a little bit deeper about the industry reshaping deal that began to change self-storage.
I'll remember it was a $2.3 billion deal. We put 500 million into it. And then we formed a lot of smaller joint ventures with various entities that Prudential oversaw the management of. So they put 1.8 billion into the deal. And it really does speak to the trust that they had. And we were able to close that very, very quickly. Now, my role was fun, right? So my role was to look at all the assets, try to determine how they would fit into our portfolio, try to figure out where we were headed. I think that the portfolio was only 70 to 80% full at the time. It had some issues kind of around occupancy. And that was a philosophy, I think, that they had adopted at Storage USA to keep rates high and not really be responsive. We're very, responsive to rates today, as you know. But they had really, I think, kept rates higher and seen erosion of their occupancy happen. So we took it over and we're a little bit more nimble on the rate analysis. And so that was my job, was to figure out how to implement that and put all those pro formas together for 460 something properties. Was quite a task.
$2.3 billion deal back in 2006. If you want to get more details about that deal and hear more about that story, check out the Stories Behind the Door podcast. You can catch that full interview on YouTube. Incredible insights into what was going on at the time and how that deal sort of fell in their lap. It wasn't something they were pursuing. Another merger that happened in the greater economy allowed them to partner with Prudential on that deal and create the basis of what today is Extra Space. Very fascinating conversation with Zach Dickens. I went on to talk with Zach about the GFC and what happened. And one of the points that he made, and others have contributed as well, as I speak to people about that era, is the companies that were well positioned with equity partners, because debt became so tight, because capital raising became so tight, the people who had a track record and had access to capital during that time, the Public Storages, the U-Hauls, the Extra Space, the Storage Mart family and their backers, which we know about, were able to grow during that period. And between 2008 and 2011, start to draw attention of other players in the industry. Stick with us. After the break, we're going to come back and we're going to dive way more into what started to happen from 2011 up till today. Storage Unlocked is brought to you by PB Brown. Over $1 billion in ground-up construction delivered, from single-story to Manhattan high-rise, institutional grade, engineered for performance, and designed to stand out. Great storage catches the consumer's eye, drives traffic, and helps lease-up happen faster. From Manhattan to Miami, California to Hawaii, PB Brown is the GC to trust for your multi-million-dollar storage development. As we start to come out of the GFC in 2011, there's some players that are starting to really see what storage is likely to become. One of those players was Tom Sherlock, one of the three founders of Talinvest. He had been on Wall Street at the savings and loan crisis, had seen the RTC, the Realty Trust Corporation, that was built by the government to sell off those assets from the savings and loans crisis. Interesting side note, the dawn of Blackstone, the largest owner of real estate in the country now, was buying those assets from the RTC. Tom Sherlock was working in the debt equity sector at the time, teamed up with his now partners and Eric Schneider. There we go. Condolences and brief moment of remembrance for Jim Davies, their third partner that passed away a couple of years ago. Want to make sure that we honor him. He was such an integral force in the industry overall and so well loved by everybody. Those three took a risk in 2011, and they decided that storage looked like it was going to take a very strong place in the hierarchy of commercial real estate assets. Up to that point, Tom had been doing 50% storage. and 50% commercial lending. And he decided that he was going to change. In hindsight, it seems like a very easy choice as we look back on the history of self storage. But at the time, they were risking everything to start Talinvest.
But of course, then it's office, industrial, multifamily, and retail. And once one of those sectors would have an issue just because of a cycle, now there's a lot of capital sitting around going, where do I go? Where do I go? How do I stay in real estate? And so that started opening up the interest level, and self-storage was one of the first ones that really had that interest level. So we had, because of our relationships, we had a view into that. And we really believed in the sector. And like I said, we made a bet. We went from 50% of our business being commercial and 50% storage to being 90% storage and 10%. And it wasn't because the commercial was going away. It's because storage was growing that rapidly. And today we're not pivoting away from storage, but we brought somebody in the hospitality sector. We do more in small bay. I know you have a small bay interest and background.
Well, fascinating conversation. You can catch the full interview with Tom Sherlock on YouTube as well at the Stories Behind the Door podcast. I went back and I grabbed that clip because I thought it was very fitting to what's going on today. So Talinvest, 2011, they start. You're going to see later when we go over the top 12 owners in storage today that 2011 was not, that Talinvest wasn't the only thing that started that year as well. Very interesting timeline. What happens from 2011 up to 2017? People start to get the bug of storage and they start buying assets. There's a fascinating conversation from my very close friend, David Perleshi. If you don't follow him on LinkedIn, you should. He does incredible interviews with some of the leading folks in the industry. He sat down with Brian Cohen, one of the founders of Andover Properties. It's on his LinkedIn page today. And Brian Cohen talked about when they started in the early 2000s, they could buy self-storage assets at 10 caps. Well, in 2011, we start seeing the shift. Talinvest noticed it early. They bring along capital. Other capital partners start coming into the sector. And what happens? Well, of course, when more people are going after an asset, cap rates start to compress. Fast forward a few years, because capital is still very hard to come by. Debt still very hard to come by in the early teens in the wake of the GFC. We get to 2017. And things start to change. The industry, the economy begins to recover, and there's a wave of new money coming into the space. Cap rates compress, and then we see the development wave take off. Why does the development wave take off? Well, if you can't buy existing assets at a basis that makes sense, but the rents are strong and the asset class is strong, you believe in the asset class, well, then you go and you try and build ground up. This information, I want to be very clear, is from Yardi Matrix. 38 million square feet built in 2017. This is only primary markets. It's important to note that, right? If you remember the graphic we had earlier, we're going to bring it up again about total supply. You can see here the SSA shows in 2018 there was 1.71 million. That went to 2.7 million. That's $1 billion. Those numbers don't add up here. You'll see there's not 1 billion square feet of new assets here on this graphic between 2018 and today. The reason for that is Yardi only tracks major markets, right? So I want to go back. In 2017, you saw 38 million square feet of self-storage delivered just in primary markets. Note that the total deliveries that year was a record. It was the most deliveries, the most square footage that had ever been delivered of self-storage. And that trend goes up through 2019, goes up almost 30%, right? To 48 million square feet delivered just in primary markets. Of course, COVID, we get a little bit of a dip, but COVID rates go crazy. So what do we see in 22 and 23? Unbelievable numbers as far as ground up development. Some of that fueled by things that had been stalled during COVID. Some of it fueled by the increasing attention of the incredible rates that these storage facilities were getting. Now we're starting to see the decline on the back end of that. The question is that decline fast enough to help turn around a 3-year trend in rates? Let's go back to the supply graphic again, the overall supply graphic. There we go. And talk about what this looks like. So 1 billion square feet. This is covering all markets now, right? Across the country. 1 billion square feet of storage built in the last 6 years, 7 years, 8, going on 8 years. And we've seen, especially coming out of 2023, as interest rates got raised, construction costs went up. We've seen a slowdown, but we also saw a massive decompression in rates. This is something that Extra Space makes no bones about. One of their responses to the incredible increase in supply, and make no bones about it, a lot of industry players will tell you that 2017, 18, 19 was too much new supply. That going into 2020, there was a lot of concern in the industry that rates were going to start to get compressed because of all that new supply. COVID, of course, was a mask that covered some of that problem. And because rates skyrocketed so much and occupancy demand went through the roof for self storage, it covered a piece of that problem. Well, if you remember the last graphic, the number of new deliveries went to 70 million in 2023. Now you've got even more new supply coming on board. Is this what we need? As we hear people in the industry talk, it certainly seems like this is going to help be something that helps slow down the trend of rate reduction. And in fact, fortunately, we've heard from most of the REITs that Q1 was the first time they've shown same-store NOI growth in quite a while, and we're hearing that move-in rates are starting to rise for the first time in years. So there is good news on the horizon as far as that goes. It seems like in the short term that we're starting to see the tide curve. You guys may remember Maurice Pagoda. He's been on the show in the past. I can remember a time when Maurice was on the show and he talked about, is actually going to be on the show again later this summer. He's going to be on this show instead of Stories Behind the Door. We're going to talk about operating a mid-tier owner of self-storage with him and one other owner. When I talked to him on Stories Behind the Door podcast, he started National Storage up in Michigan in the 1980s into the 1990s. He wouldn't develop storage in a market if there was 2 square foot per capita there. To think that today we're almost at 8 square foot per capita nationally, and we're still getting 50, 80, 100 million square feet of new developments being built every year is mind-blowing. What saves storage, in my opinion, is not just the fact that the usage rate went up. It's the incredible amount of usage that individuals in the US are showing now, right? So not just that building has come down, right? Because we saw that huge spike and we're starting to see the decline. But what's happened simultaneously is the percentage of people in the country using self-storage has risen markedly. If you turn this back to 1995, 6% of people, going back to the beginning of the timeline I was looking at from 2006, you're right about 10%. Now we're up to 16%. This has really been driven by a massive increase in usage between millennials and Gen Z. They're both using it about a 16% clip. Of course, baby boomers now starting to age out of the population using storage. There's some other things that I think have contributed to this. One of them being the design of facilities now. They're much more appealing. They're much more commercial looking than they were 20, 30 years ago when you had sort of the first generation Citadel Fortress style self-storage. And that's borne out in the numbers as women actually tend to rent self-storage now more than men. The demand drivers for self-storage, part of this is one of the things that's hard to fathom in 2026 because the housing market is still at a historically low level as far as transactions go. While there are more renters and renters tend to move a little more, it certainly doesn't suggest the type of movement that's going to make up for the slow movement and the overall housing purchase market. Will this continue? We've seen 167% surge in usage rate since 1995. The question becomes, can this continue into the next decade to help make up for what's going on there? I want to show the population growth chart, and this is something that starts to be important for those of you that are looking at investing in storage, or especially if you're looking at building ground up self-storage. Credit to my friend Chris Berg. This is something that he talks about a lot. The crackdown on immigration in the United States has led to historically low immigration numbers. You could see that 0.5% in 2025. If you go back to 07, that number was almost at 1%. We saw it almost at 1% in 2024. Of course, I'm not going to get into politics on this show, but it certainly makes sense given the two different administrations, the one that was in place in 24 versus the one everyone knew was coming in 2025, that folks would have made an effort to get their immigration done in 2024 before it became a little bit more challenging. Hand in hand, this is population growth, by the way. So only one of the drivers is immigration, which is cut down immensely. The other thing that's happened, of course, is the birth rate is going down. There's been a dramatic slowdown in the number of babies that are being born in the United States. So you have a dual driver of this decrease. Neither of those two things seems like it's going to reverse in the short term, right? Not going to be a huge change in immigration, certainly not in the next couple of years. And the birth rate doesn't show any signs of turning around anytime soon. Of course, you'll see the drastic slowdown in 2021 during the middle of COVID, sort of an outlier there. But even going into COVID in 2018, 2019, you saw the massive slowdown in population. So we need the percentage of Americans using storage to continue to rise. If the slowdown in the housing market continues for the foreseeable future, which certainly there are not a ton of signs that that's going to loosen up a lot, we'll pay attention to what the Fed does here very quickly, but doesn't appear like there's going to be any serious number of cuts to their overnight rate this year, if there are any at all. We'll see what happens there. A lot of people expect one or two. I am not holding my breath waiting for that. I tend to fall on the other side of it. I don't think there's going to be increases, but I think they're going to hold with the status quo for the foreseeable future. We're going to need for more people to be utilizing storage as a percentage of the population, as the population growth continues to slow down. And even with 30 million square feet of new self-storage, that's just accounting for primary markets. It's still a lot of new supply that has to be absorbed and trying to keep rates where they've been. Stick with us after this break. We'll break down after we come back the top 12 owners in storage today and how there's a startling delineation between them. Storage or small bay flex, execution matters. S3 Partners moves projects from concept to completion with 3 integrated services. Project Sync manages your development, vendors, timelines, budgets, and construction oversight. Market Expansion sources opportunities in the right markets to grow your pipeline. And Deal Sync delivers institutional level underwriting so you can pursue projects with confidence, helping you move faster and build smarter. S3 Partners, storage, flex, growth. We're going to finish up today with a quick look at the landscape of ownership as it stands today in self-storage. And you're going to see by this graphic a pretty clear break of the then and the now on this side of it. Of course, if you look at the left-hand side, it's the then. You see Inland Devon down there. That 2015 number is a little misleading. Inland was started in the 1960s across multiple real estate asset classes. They had a portion of self-storage. They absorbed Devon self-storage in 2015, which itself started in the 1980s. So if you look at that side of the chart, really Storage Mart, by the way, Storage Mart, the Burnham family, shout out to the Burnhams, such great supporters of the show. Appreciate them greatly. They got into storage in 1973. The Storage Mart brand, actually the second iteration of their family storage investment. So you're talking about 50 plus years of self-storage for that company. CubeSmart in 1985 was, of course, U-Store. Those 5 making up 5 of the top 12. I left NSA and U-Haul out of this chart. Of course, NSA is going to be a part of Public Storage here in the third quarter of this year. And U-Haul I left out only because the company started in 1944 as purely a moving company. They weren't really in the storage business yet. And they're still not primarily a storage company. They're primarily a moving and logistics company who use storage to help drive that side of their company. Flip to the other side, and this is where it gets interesting. I said earlier, 2011, Talinvest wasn't the only thing that started. CityLine Capital, Rick Shantz here in Philadelphia, where I'm at. He's on the other side, on the main line side of Philadelphia. I'm over in New Jersey, in the Jersey suburbs. But CityLine Capital started in 2011. H. Michael Schwartz and SmartStop, Prime Storage, and Robert Moser. Storage Rentals of America in 2013. Merritt Hill, of course, Liz Ron Schlesinger, legend in the self-storage industry in just a decade, starting in 2016. Why did I put this graphic up? Well, look at the number of private equity companies that have been able to come into storage even in the last 15 years and become top 12 players, right? As I said, the only two of the top 12 that are left off here are NSA and U-Haul. Interesting note, I mentioned Andover Properties early, Brian Cohen, who's on with David Perleschi. They're number 13 on the list, so they just barely made it. They started in 2003, so they go in the middle here. They wouldn't have made a good look on the graphic, but just very startling to see the amount of private equity money that's come into self-storage in the last 15 years and what it's done to cap rates. We're still seeing, we talk about this on the show frequently. We talked about it a lot with Austin McLeod and John Lindsay last week on the broker roundtable. Still got cap rates in the low fives, even under five in some primary infill markets, sixes and below in secondary markets, sevens and below in tertiary markets. Why are we still seeing that? Well, you have these companies that grew very rapidly. They brought a tremendous amount of capital. They were able to raise capital at prices and rates where they could go out and they could pursue these facilities at these low cap rates and still have a path to get to profitability. That's what drove in my opinion, that's what drove the incredible explosion of ground up development. These companies were paying a premium cap rate. Rates are really good. Ground up development start to pencil really well. Fortunately, as we move into the second half of it's hard to believe, in 12 days, we'll be in the second half, and 13 days, we'll be in the second half of 2026. We're starting to see development slow down a little bit. I'm going to say what I've been saying for a long time on this show. Listen, S3 Partners, we're owners reps. We project manage ground up self-storage. We develop ground up self-storage ourselves. We've got a massive project working right now, 240,000 square feet. What I urge you is, if you are looking at a ground up development project and you don't have a long track record in the self-storage space, if you're coming from another asset class and you've heard self-storage is great, and it's such an awesome industry and development works great, make sure you surround yourself with experienced people, because it's millions and millions of dollars. It's millions and millions of investors' dollars that are important to them that you're going to put, whether you use syndication or you use private equity, you use family office. The last thing you want to do is go build a facility that is not needed in a market. So make sure you surround yourself with experienced people in the market. Feel free to reach out to me. I'm happy to give a high-level overview of what I think of a project. You can touch base with me anytime. I'd love to do that. Hope you enjoyed today's show. This wasn't the easiest one to do. It's a lot of research and a lot of talking without a whole lot of people, to have interaction with. There's a lot of just Thaddeus Campbell talking, but something I feel very deeply about, something that I care about. I want to give a quick shout out to my friends at Tract IQ. Talked to Noah Starr earlier today and thank him greatly for giving me insight onto the Yardi Matrix numbers, right? The Yardi Matrix numbers don't add up with the SSA numbers as far as what's been built in the last 10 years and what's happened to total supply, only because Yardi Matrix only tracks primary markets. Keep an eye on Tract IQ. I know a lot of you guys are already, and shout out and good luck to Noah. I know he and Chris Burton are on later today for their second seminar. Tune into that if you haven't seen it, how they're integrating their platform with AI to make it so much easier to underwrite and get an institutional grade underwriting model of a project using their data. Their platform is going to have a lot of this data in a much more clear and concise way industry-wide. Just to give a little bit of example, Yardi tracks 30,000 stores in the U.S. Tract IQ right now tracking 72,000 self-storage facilities across the U.S. and, of course, also have access to the CMBS data, giving you exact rates in stores that have CMBS loans, as well as the exact occupancy numbers. So I want to give those guys a shout out. Noah Starr and his team at Tract IQ doing an incredible job on the data front. Before I sign off today, as always, I want to give you a quick look at upcoming SSA events regionally and nationally. Next week is the Great Lakes Show. I wish I could get out to Chicago, a beautiful place to go visit and spend time, especially this time of year. So next week is the Illinois SSA Great Lakes Owner Summit and Expo. Not too late to get out there and check out that show, especially if you are in the Midwest. A lot of players from around the country descend on that Chicago show. It turns into much more of a national type show than just a regional show. So make sure you get out there if you can. And then September 8th to the 11th, hard to believe, but National SSA is back at Aria Resort and Casino. If you were there for last year's 50th anniversary, you know how much better that show was for the location. Such an awesome time at Aria. Look forward to seeing everybody in September out in Las Vegas. Well, I hope you got something out of today's show. I know I learned a lot in researching it and putting it together. Hopefully I was able to translate that to you in a way that made some sense to you. I'm your host, Thaddeus Campbell. That's it for this week's edition of Storage Unlocked. Again, want to thank our friends at PB Brown General Contractors. Without their support, this show and the information that we bring to the industry would not be possible. If you have a ground-up development project, reach out to Guy Sacento and Hano Montoya at pbbrown.com. Get them involved early. They've built hundreds of self-storage facilities, specialize in major infill and primary markets, building legacy-type self-storage projects. Reach out to them and get them involved early. That's it for this week's show. Have a great week. We'll see you next week.